Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, it's been a quite incredible week on investment markets. If you recall, in last week's show, I talked about how the bulls and the bears were fighting it out at a key resistance levels on most stock markets, to be fair. But in particular, I looked at the S&P 500 and the 3,000 level. And that 3,000 level was key for a number of reasons. Obviously, it's psychologically a nice round number. It was also the 200-day moving average on the S&P 500, which, if you recall, if you tend to be above the 200-day moving average on a stock market indices, that tends to be seen as a bullish sign. Now, we wanted to push above that if the market was going to confirm this was a lot more than just some bear market rally. And through the latter part of May, we'd seen the stock market in America try and push above the 3,000 level and then that be rejected and it pull back. But what we saw in the last few days of May and now at the beginning of June is the market confirmed more to the upside, and it finally broke and closed above the 3,000 level. And not only that, if you look at your stock market indices app on your phone, you will probably see that as I make this video, the S&P 500 then pushed on and broke above the 3,100 level. Now, on its own, that's quite incredible. And that gives a lot more weight to the idea of the market being in a more sustainable upward trend, pushing ultimately, or trying to push back towards the all-time highs we saw in February. Now, of course, in other markets around the world, we've not been near all-time highs for some time. But even in the UK, the FTSE 100 pushed above that key 6,000 level, above levels we hadn't seen since March. In Japan, the Nikkei 225 pushed above that key 22,000 level that I mentioned. And so the dynamic changed from one that was a potential turning point, that if the market was going to turn lower, it needed to do it. It was running out of time almost, as I mentioned last week, to pushing through those levels. And it was firmly another tick in the bull argument that markets could keep pushing higher. Now, the market is completely detached from fundamentals. We know this now, and it seems to be getting ever worse. And it seems the market's only focused on liquidity. So that liquidity provided by central banks, particularly the central bank in America, the US Federal Reserve. And that liquidity backstopped the bond market. And in fact, they released the numbers of the amount of bond buying they'd been doing in America. So the US Federal Reserve has been buying the bonds in America, and the numbers were eye-watering. And over the last few weeks, I've been talking a lot about what we'd want to see to confirm that maybe the bottom was in the market. And some of those things were bond markets stabilizing. So bond markets have stabilized. What the Federal Reserve tried to do, they are succeeding in doing. And when the bond market stabilized, I used an analogy of a skyscraper and the foundations being solid. That was the bond market. It therefore brought more stability to the higher floors, which is the equity market. Now, we've seen that, but then when you look at different indicators for markets to try and work out if the market could push higher, you look at a lot of them. No one indicator is infallible. So the bond market seemed to be confirming that perhaps we're in an environment that could be more favorable for stocks than we were previously. But then if you looked at the breadth of the stock market, so that was a measure of how many stocks were closing above their 200-day moving average. Now, I talk about US stock markets quite a bit, and it's reflective of a lot of stock markets globally, because a lot of stock markets globally will start to follow the trends that are set in America. There has been a divergence. I know we've had US stocks pushing higher on this FOMO, this fear of missing out, while stock markets around the world have lagged somewhat. That trend has started to also reverse slightly. We've seen European markets start to outperform in recent days and almost playing catch up. So that divergence, it was either going to catch down, US stock markets collapse, or global markets, European markets start to catch up. It looks like at the moment we may be in that latter category, which would be positive news for those who think the market will go higher. But the breadth has been improving. So we'd started to see more stocks pushing higher, not just being led by those key tech stocks, those stocks that had performed well during the heightened fear during lockdown. So the Amazon stocks, other online retailers, and we saw other sectors start to catch up as well, cyclical sectors. So we saw rotation. We want to see rotation in stock markets that are rallying, that are going to be sustainable in a bull market. So you don't just want one or two sectors leading the charge. You want to see money rotate out of the leading sectors and move into some of the unloved ones. And we are seeing that. Financials, for example, have rallied hard in the last week or so. So we are not only seeing improved breadth, we are also seeing the market push above key resistance levels, which are now turning into support levels. We're seeing that across the board. We're seeing the VIX, the VIX, so that's the fear gauge. And that was one of the last levels that the bears were clinging on to, that the VIX is still above its 200-day moving average. And the 200-day moving average on the VIX has been moving high. It was around 20, but it's now up to around about 24, and the VIX has fallen down to around 25. So even that signal could start to confirm that we are in an environment that is much more supportive for stock markets. Bonds are starting to pull back. Some of the haven assets that we've seen, including the Japanese yen, are starting to weaken. So all these things are starting to add weight to the argument that stock markets could perhaps go higher. It doesn't mean the economy is improved. The fundamentals are completely detached. It doesn't mean that we won't necessarily have a pullback later in the year if we get another second wave of the coronavirus or the economy globally doesn't improve as fast as people had hoped. But all these things are ticking off in favor of the bulls, which is giving people more FOMO, more encouragement to start back in stocks. And you're starting to see trend followers enter the market. Now, one indicator which looks at the average over the last 10 months, and it's something I've written about for 80/20 investor members. So if you want to know more about it, go and take out a free trial. And I talk about it as an indicator that's good at picking tops and bottoms of stock markets. It's not infallible, but when the indicator starts to flash that the market is rallying in a sustainable way, that buy signal flashed at the end of May. As I say, it's not infallible, but what it's done, it's another one of these signals that's starting to suggest that the bulls are finally winning over the bears. Now, the bears would need to push the market down much lower. We'd need to see some aggressive selling, but we've got to the point now where it almost seems that investors are almost unanimously thinking that the Federal Reserve does have their back. So the market is still trying to push higher in the short term. And that's despite the ongoing trade war saga that we've got in America. Again, as I say, the economic fundamentals still not being great. And of course, we've also got the social unrest that we're seeing in America. And all these things are adding to a slightly uncertain backdrop. But equity investors don't seem to care and are pushing onward. So in the coming days and weeks, we want to keep an eye on those key support levels that we see in a lot of markets. So in the S&P 500, it's 3,100, and then down towards the 200-day moving average, and then 3,000. It seems to be the market is just obsessed with technicals at the moment rather than fundamentals. And unless something happens, which is likely going to be probably Donald Trump is going to be involved, then can anything derail this equity market rally? So that is it for this week on Damien's Midweek Markets. You can get in touch with me in the usual way. Damien@moneytothemasses.com is the email address. You can get in touch with me on Twitter, Money to the Masses with the number 2. Instagram, of course, subscribe to our YouTube channel, and don't forget to join our Facebook group, which you can find at facebook.com/groups/Money to the Masses.